The most powerful tool in the toolbox for expats is the foreign earned income exclusion. I have a lot of videos on this where you can look at exactly how to calculate it, some of the nuances associated with it. In this video, I wanted to specifically talk about one of those nuances, which is called the stacking rule, and particularly how it can affect taxpayers trying to plan for their taxes in the future or potentially surprising them into how their taxes are actually calculated when it comes to the foreign earned income exclusion. My name's Alex McGowan, owner of McGowan Tax, where we provide practical international tax solutions to small businesses and individuals. So this stacking rule specifically has to do with the tax rate that's being applied to your other income outside of the foreign earned income exclusion. So the basic idea is that you get the foreign earned income exclusion for purposes of calculating or how much income is subject to tax, but you have to add it back in figuring out what tax rate. With the foreign earned income exclusion, you do get to remove that amount of income when determining how much income is subject to tax. So it is a direct exclusion of income from your tax. But in coming up with your tax rate and certain taxes that you're subject to, you have to add that income back. So I'm going to talk specifically about a client example that I recently ran into where they were trying to come up with their estimated taxes on a long-term capital gain that they knew they were going to realize this year. And so they wanted to try and figure out how to estimate their taxes on that income going forward and potentially stay in that 0% tax bracket. Capital gains taxes, specifically long-term capital gains, are in a different bracket structure than your regular ordinary income. So long-term capital gains are taxed at either 0%, 15%, or 20%. And then there's a 3.8% net investment income tax that can be tacked on if you hit another income threshold. If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. So most people fall in that 15% bracket, which if you're married filing jointly, it's like 90,000 of income up to around 500,000 of income. Once you get over the 500, that's where the 20% kicks in. And if you're filing single or another bracket, that can be potentially half the amount of income. But if you're filing in another filing status, like single, married filing separate, that could be half or just a different rate structure that you need to go look up. But specifically for this individual, they were married filing jointly. And so the 0% tax rate was 90,000. So in this scenario, let's just to make the math easy, let's say they earned $130,000 of wage income that was eligible for the full foreign earned income exclusion. So in that scenario, the foreign earned income exclusion for 2025 would completely wipe out their income. So they'd have no income left because the exclusion amount is up to 130,000. So then they're looking at their long-term capital gain. So they want to keep that long-term capital gain in the 0% bracket so they don't pay any taxes on that either. So the long-term capital gain bracket was up to about $90,000 of total income. So how that bracket works, it doesn't just look at your long-term capital gain income, it looks at your total taxable income to see if you've crossed the 90,000, and then it applies the appropriate rate, which would either be 0 or 15%. So how the stacking rule works is it adds back that 130,000 in determining what bracket you're in for the long-term capital gain. So for the long-term capital gain, we'd take 90 plus the 130, so that'd be $220,000 of total income, which would squarely put them in the 15% bracket. Whereas what they were thinking is that they're getting a full exclusion of the foreign earned income exclusion, so that income would be 0, and their only income left is the 90,000 or whatever the capital gain would be, which is the way the tax return is going to look, but it's not the way your tax is calculated. That's an important and very common example of how that stacking rule can apply. And the other side of this, which isn't really the stacking rule, but it's a similar concept, is the net investment income tax. So that tax is a 3.8% tax on your net investment income. And it triggers when either if you're filing jointly, your total income is over 250,000, or filing single or separate, I think it's 125,000 or somewhere close to that. In that scenario, it's a very similar concept to where if your income crossed that threshold, you have to add back your foreign earned income exclusion. exclusion. So if you have $100,000 of long-term capital gain and all of your earned income is excluded, you're not under the threshold necessarily, because if you had $130,000 worth of earned income that was excluded, you have to add that back in determining if the $90,000 crossed the threshold to be subject to the net investment income tax. So that's another example of where this add back of the foreign earned income exclusion is very important in coming up with other taxes. So just to summarize the takeaway for that, the stacking rule essentially makes you add back the foreign earned income exclusion in determining what tax bracket you're at. So that's the tax bracket on your ordinary income as well as the tax bracket on your capital gain income. And it also applies to things like the net investment income tax in determining your threshold. So if you're trying to estimate your taxes and you're taking the foreign earned income exclusion, obviously that's going to be a huge benefit to your taxes. You're going to save about $20,000 if you're able to take the full exclusion, but you need to be cognizant of the fact that you are going to have to add that back potentially in coming up with your actual tax rate, even though you're still getting the benefit of that exclusion. If you need help estimating your taxes or applying the foreign earned income exclusion to your situation, feel free to reach out to us and you can book a consultation directly with me at McGowanTax.com.